Your bank hands you a free checking account, a debit card, a slick app, and a branch with friendly tellers. And somehow they are pulling in billions. JP Morgan Chase collected roughly $92 billion in net interest income during 2024 alone. And Bank of America splits its revenue nearly 55-45 between interest income and fees. These are publicly traded corporations with shareholders who expect returns every single quarter, not community nonprofits handing out favors. What this video will do is show you exactly how your bank profits from the way you handle your money, and more importantly, what to do about it once you see it. 5 curtains are coming down today, and by the end, you are going to look at your bank accounts in a completely different way. The most basic question nobody asks is how a bank actually earns money in the first place. At the core sits something called the net interest margin, and here is how the whole thing works. You deposit $1,000 into your checking account and the bank pays you almost nothing for that money. Chase savings accounts right now pay 0.01% AP, which means $10,000 sitting there earns you $1 per year. But your deposit does not just sit in a vault gathering dust. Banks lend that money out to fund mortgages, auto loans, credit cards, and business lines of credit, and on those products they charge dramatically higher rates. Credit card APRs right now average about 21%. New car loans at big banks run around 7.4%, and mortgages sit near 6.5%. That spread between what the bank pays you and what they charge borrowers using your money is the net interest margin. Across the entire banking industry, that number hit 3.39% in the fourth quarter of 2025, the highest since 2019. Community banks ran even higher at 3.77%. What that means is that a free checking account is not generosity. Your deposit is the product. Every dollar earning 0.01% in your account becomes a dollar the bank lends out at 7, 10, or 21%, and the free checking account is just the acquisition cost for your capital. And it turns out to be a spectacularly good deal for the bank. This explains why banks pour millions into branch locations and Super Bowl ads and sign-up bonuses. They are not trying to help you save. They are trying to gather deposits, because the more deposits they hold, the more they lend, and the wider that margin stretches. Net interest income is the biggest piece, but about 30% of total bank revenue across the industry comes from fees and other non-interest income. At Bank of America, that number climbs to nearly 45%. Overdraft fees, maintenance fees, ATM fees, late fees, wire transfer fees, foreign transaction fees. The way those fees are structured tells you everything about who the bank was actually designed to serve. Overdraft fees are where the incentive structure becomes impossible to ignore. Back in 2019, American banks with more than $1 billion in assets collected $11.97 billion in overdraft and non-sufficient funds fees. Across the full market, including smaller banks and credit unions, that number reached an estimated $15.47 billion. And since the year 2000, Americans have handed over roughly $280 billion in overdraft fees. That is not a typo. But here's the part that changes how you think about this. According to the CFPB, just 9% of account holders pay 79% of all overdraft fees. These are people overdrafting more than 10 times a year with a median account balance under $350. Nobody living with $350 in their checking account is being careless. They are living on the edge, and the fee structure pulls the maximum amount of money from exactly that situation. The demographics make the pattern even clearer. Households earning less than $65,000 get hit with overdraft fees at 3.4 times the rate of households earning over $175,000. Black consumers are 69% more likely than white consumers to live in a household that pays an overdraft fee, and Hispanic consumers are 60% more likely. 43% of people charged an overdraft fee reported being surprised by it, and the math on what these fees actually represent will stop you cold. A typical debit card overdraft runs about $26 according to the CFPB, gets repaid within 3 days, and triggers a $35 fee. Express that as an annual percentage rate the same way we measure every other form of lending, and it comes out to over 16,000% APR. A $300 overdraft repaid in 10 days with a $35 fee works out to roughly 426% APR, which puts it right alongside payday loans. Your bank just does not call it a loan. They call it a courtesy. And that brings up the obvious question of why a bank would allow a $5 coffee purchase to go through when your account only holds $3. Declining the transaction earns them nothing, but allowing it earns them $35. Before 2010, banks could charge overdraft fees on debit purchases without even asking your permission. That changed when the Federal Reserve amended Regulation E, effective July 1, 2010, requiring banks to get your affirmative opt-in before they could charge overdraft fees on ATM withdrawals and one-time debit card purchases. Every new customer defaults to not enrolled. But banks turned out to be extremely good at getting people to opt in. They frame it as overdraft protection and call it a courtesy or a service or a safety net. The CFPB found that opt-in rates at large banks range from 13 to 44%, with some institutions pushing 75% or higher. One regional bank's data revealed that 93% of customers who overdrafted 25 or more times in a single year had opted in. The people who can least afford the fee are the most likely to have signed up for it. And then there is the transaction reordering chapter. For years, major banks processed debit transactions not in the order customers made them, but reordered them from largest to smallest. The big purchase drains the account first, and then every small transaction behind it triggers a separate overdraft fee. Wells Fargo built this into their system, and Judge William Alsup called it out on August 10, 2010 in Gutierrez v. Wells Fargo, ruling the bank's high-to-low posting order unfair and fraudulent. His court found that the bank's dominant, indeed sole motive, was to maximize the number of overdrafts. An internal memo had projected this reordering would generate an extra $40 million a year in fee revenue, and the court found it quadrupled overdraft revenue per occurrence. $203 million in restitution followed, and the bank had charged California depositors alone $1.4 billion in overdraft fees between 2005 and 2007. Wells Fargo was not operating in isolation either. Bank of America settled a massive class action for $410 million, covering 13.2 million customers. Citizens Financial settled for $137.5 million, and TD Bank settled for $62 million. These were not isolated disputes. They were systemic practices across the industry. Some banks have actually changed direction since then. Capital One eliminated overdraft fees entirely in December 2021, and Citibank followed in February 2022, becoming the first megabank to kill them completely. Bank of America dropped its fee from $35 down to $10, while Ally and Discover moved to $0. But plenty of others have barely budged. Wells Fargo still charges $35 per overdraft as of 2025. PNC charges $36, and U.S. Bank, Truist, and TD Bank all sit in the $35 to $36 range. JP Chase brought in over $1 billion in overdraft revenue in both 2023 and 2024, and Wells Fargo collected close to $1 billion both years. The regulatory picture matters here too. The CFPB under Director Rohit Chopra finalized a rule in December 2024 that would have capped overdraft fees at $5 for banks with more than $10 billion in assets. The CFPB projected it would save consumers $5 billion a year, roughly $225 per overdrafting household. That rule got repealed. Congress passed a resolution under the Congressional Review Act, with the Senate voting 52 to 48 on March 27, 2025, the House voting 217 to 211 on April 9th, and President Trump signing it on May 9, 2025. Under the Congressional Review Act, the CFPB cannot issue a substantially similar rule without entirely new legislation. Credit card late fees went through the same cycle. The CFPB had finalized a rule in March 2024 capping late fees at $8, down from the typical $30 to $41. A federal judge in Texas vacated that rule on April 15, 2025, after the CFPB under new leadership consented to dropping it. None of this is meant to make you angry. The point is that the regulatory environment has shifted, and the responsibility for protecting yourself from these fee structures now falls more directly on you. That might not be how things should work, but it is how they work right now. Monthly maintenance fees are the next layer. Chase Total Checking runs $15 a month after going up from $12 in August 2025. Bank of America Advantage Plus charges $12 a month, and Wells Fargo Everyday Checking charges $15, up from $10 in late 2023. All of these can be waived, but the waiver thresholds tell the real story. Chase drops the fee if you carry $500 or more in direct deposits per month, maintain a $1,500 daily balance, or hold $5,000 across linked accounts. Bank of America waives for a $250 direct deposit or a $1,500 daily balance. Wells Fargo waives for a $1,500 daily balance or $500 in electronic deposits. Think about who cannot clear those bars. Anyone living paycheck to paycheck whose balance dips below $1,500 between pay periods pays $15 a month just to have a checking account. That comes to $180 a year. According to the Bankrate 2025 study, the average minimum balance needed to waive fees on an interest-bearing checking account has climbed to $10,210, up 18% in a single year. Only 47% of non-interest checking accounts charge no monthly fee at all, which means the majority charge something. Free checking peaked around 2009 when roughly 78% of banks offered it, and by 2015 and 2016, that figure had dropped to 46%. The FDIC's 2023 National Survey of Unbanked Households found something that puts this into sharp focus. The number one reason Americans give for not having a bank account at all is don't have enough money to meet minimum balance requirements, cited by 42% of unbanked households. The fee structure is literally pushing people out of the banking system. Once you are pushed out, the spiral gets worse. A 2025 Philadelphia Fed working paper found that unpaid overdraft fees reported in check systems can block you from even opening an account at another bank. The overdraft fee you could not afford becomes a wall between you and the entire banking system. Your savings rate might be the quietest way your bank profits from you. Right now, the federal funds rate sits at 3.50 to 3.75%, which is the baseline cost of money in the economy as set by the Federal Reserve. High-yield online savings accounts track that rate fairly closely, paying somewhere in the range of 3.2 to 4%. Chase pays 0.01% on a standard savings account. Bank of America pays 0.01%. Wells Fargo pays 0.01%. The federal funds rate sits at 3.75%, while your big bank offers you 0.01%, a gap of 374 basis points. Your bank pays you roughly 1/375th of the federal funds rate, and that gap represents real money walking out of your pocket. On $10,000, a Chase savings account earns you $1 per year. That same $10,000 in a high-yield savings account paying around 4% earns approximately $400, a $399 difference on the exact same pile of money. Scale that up to $50,000 and the annual gap hits roughly $1,800. At $100,000, it crosses $3,600 a year. You are giving your bank a free loan and collecting almost nothing in return. Bankrate reported in 2025 that 2/3 of American savers earn less than 4% APY on their savings, and 17% earn no interest whatsoever. Americans hold their checking accounts for an average of 19 years, and savings accounts for an average of 70. We stay deeply loyal to banks that are not loyal back. 45% of Americans cite branch access as their reason for not switching, which is understandable. But here's the thing. You do not have to leave your big bank entirely to fix this. Keep your local checking account for everyday transactions and open a separate high-yield savings account online. Your money transfers in a day or two and immediately starts earning 300 to 400 times what your big bank was paying. Credit cards are the final curtain, and while credit scores deserve their own video, you need to understand the profit model underneath them. Average credit card APR across all accounts right now runs about 21%, and for new card offers, it climbs to roughly 23.75%. The CFPB found that card issuers set their rates with an average margin of 15.4 percentage points above the prime rate, an all-time high. Total U.S. credit card debt reached $1.28 trillion by the end of 2025, a record. In 2024, credit card companies collected $160 billion in interest charges from consumers. Late fees in 2022 added another $14.5 billion on top of that. Minimum payments are where the profit machine really hums. Banks typically set them at 1 to 3% of the balance, and on a $5,000 balance at 20% APR, that minimum payment stretches the payoff timeline past 30 years and costs more than $8,000 in interest. You end up paying nearly triple what you originally borrowed. That structure exists by design, because the minimum payment is not meant to help you pay down your debt. It is meant to keep you in debt as long as possible while remaining current on your account. About half of all cardholders revolve a balance month to month, and among subprime borrowers, that rate jumps to 72 to 88%. The CFPB found that revolvers earn just 27% of credit card rewards, but shoulder 94% of all interest and fees. In other words, the rewards program runs on the backs of the people who can least afford their balances. Capital One's annual report lays out the business model directly. Their net interest income for 2024 hit $31.2 billion, driven by, and this is their language, higher average loan balances and margins in our credit card loan portfolio. Higher balances, that is the goal they are reporting to shareholders. Here is where all of this comes together. Banks are not villains. They are businesses operating within incentive structures that reward them for gathering cheap deposits, allowing overdrafts instead of declining transactions, keeping savings rates anchored near zero, and extending high-interest credit to people who carry balances. Once you see those incentives clearly, you can stop functioning as the product and start operating as the customer. You can begin most of this today. Check your overdraft settings first. Log into your bank's app or call them and confirm whether you opted into overdraft coverage on debit card transactions. If you did and you do not want to pay $35 for a $5 mistake, opt out. Regulation E gives you that right at any time with no charge, and your transaction will simply decline if you lack the funds, which honestly beats a $35 fee every time. If you are paying a monthly maintenance fee, either meet the waiver requirements or switch to an account that does not charge one. Capital One 360 checking carries no monthly fee and no overdraft fees. Ally charges no monthly fee. Discover, SoFi, and Schwab all offer no-fee checking, and Charles Schwab's Investor Checking reimburses every ATM fee worldwide with no foreign transaction fees and no maintenance fee. These accounts exist, and the only reason most people do not use them is inertia. Open a high-yield savings account without closing anything you already have. Keep your checking where it is for bill pay and direct deposit, but move your savings, your emergency fund, and your sinking funds into an online account earning 3.5 to 4% instead of 0.01%. Marcus by Goldman Sachs Alley, Capital One, 360, Performance Savings, American Express, SoFi, all of them carry FDIC insurance up to $250,000, the same as your big bank. The only difference is they actually pay you for holding your money. Take a serious look at credit unions while you are at it. Credit unions operate as not-for-profit cooperatives owned by their members rather than shareholders. NCU data shows they offer lower rates across nearly every product, with new car loans averaging 5.44% versus 7.41% at banks, and credit card rates averaging 12.58% versus 15.27%. On a $30,000 car loan, the credit union rate saves roughly $1,580 in interest. The average household banking at a credit union saves between $281 and $361 a year, with high-use households saving up to $1,000. And if you carry a credit card balance, pay more than the minimum. Even an extra $50 or $100 a month changes the math dramatically. That $5,000 balance stretching past 30 years on minimum payments compresses to a fraction of that timeline when you double or triple the payment, saving you thousands in interest. Your card issuer will never suggest you do this because it works against their revenue model, but it works entirely in your favor. Your bank is not your financial advisor. Your bank is a business that profits from the spread between what they pay you and what they charge others using your money. They profit when you overdraft, when you leave your savings parked at 0.01%, and when you carry a balance and pay the minimum each month. None of that makes them evil. It makes them a business. But you are allowed to be strategic about this. You are allowed to opt out of overdraft coverage, move your savings to an account that actually pays you, bank at a credit union, and understand the game well enough to play it differently. The banking system was not built with your best interest in mind. It was built with their best interest in mind. And the single most powerful move you can make is to understand that, then set up your accounts accordingly. That is how you level up your banking.